Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report brought to you in association with the Bank of New Zealand. Today I want to talk about the New Zealand dollar and the prospect for currency controls and capital controls. Why am I talking about something which we would never have talked about in the years gone past? Well, the entire global financial system, particularly the big currencies, are engaged right now in what many people describe as currency wars. We're seeing competitive devaluations between the world's biggest central banks, attempts to get stalled economies going by cutting exchange rates. Now, when everyone tries to do it, you see chaos on global currency markets, and that's what people are talking about right now. There is the prospect that the US Federal Reserve will unleash a second round of quantitative easing, or money printing. That's where it buys US Treasury bonds to push down long-term interest rates. They're already at record lows. In fact, the official cash rate in the US right now is 0.25%. This unleashed a move last night by the Bank of Japan to cut its official rate to 0% and to unleash its own plan for quantitative easing, about 60 billion US. Now, the problem here is when these big currencies like the US dollar and the yen, and we're seeing it too with the Chinese currency and with the European euro, try to get involved in these competitive devaluations, then money looks to go elsewhere. It looks to go to currencies that are free-floating, where there's significant demand for commodities and where the price looks like it's rising. So people are looking to put their money into emerging markets or to commodity currencies, and that includes the Australian dollar, the Brazilian real, the South African rand, and the New Zealand dollar. Now, this means there's intense pressure on those currencies upwards and threatening to push them so high that they destroy their export sectors, particularly those ones that aren't involved in commodity exporting. Now, this is causing many people to call for a new version of the Bretton Woods Agreement. This was the 1944 agreement which essentially created the US dollar as a reserve currency. Or another Plaza Accord. Back in 1985, various big nations got together and agreed on a devaluation of the US dollar. Now, will this happen? We don't know, but for now there is this intense pressure on currency markets around the world, and New Zealand needs to think about being defensive about its own position. We're seeing the gold price at a record level, and New Zealand can't just sit back and wait for its currency to head towards 80 cents and for its export sector to be destroyed. What are our defensive options? Well, there are a few ways in which we can control our currency and control capital flows to try and avoid another surge in the New Zealand dollar. We also need to find ways to reduce our foreign debt and to avoid another surge of foreign debt coming in to boost asset prices and find us more indebted. And the other reason why I think we need to look at these types of controls is that, frankly, the last 4 or 5 years didn't work. With completely free and open movements of capital into and out of New Zealand, we saw New Zealanders go on a foreign debt-fueled spending spree, particularly into property. And you can see here with our GDP per capita that we're actually back now at 2004 levels in GDP per capita in New Zealand, even though our foreign debt has risen by $96.5 billion. It just didn't work. So, what do? There's a few options, and here's what I think we could do to try and protect the New Zealand dollar, protect the New Zealand economy, and try and build in some resilience and remove the risk of our economy getting further into debt. Firstly, I think the New Zealand Reserve Bank can intervene in the currency markets. It did it before in 2007 with a reasonable amount of success. It certainly made a big profit for the taxpayer. If we see the US dollar, the New Zealand dollar head towards 80 cents US, I think there's an opportunity for the Reserve Bank to jump in and intervene again. Secondly, the Reserve Bank could increase the core funding ratio from where it is at the moment, 75%, to upwards of 90%. Now, the core funding ratio essentially stops the banks from going onto the hot money markets to borrow. It means they have to have at least now 75% of their funding from local and long-term sources. I'm saying, why don't we just ratchet that up a bit higher, which effectively forces New Zealand savers to put money in the bank and for the banks to repatriate foreign debt. Thirdly, we could stop investment in large assets by foreign investors. Right now, investors are looking to get out of the devaluing currencies like the US dollar, like the yuan, like the yen, into assets, hard assets, in countries like New Zealand. So they're looking to buy mines in Australia, they're looking to buy land in Brazil, and they're looking to buy land in New Zealand and other big assets. We should look at it. Obviously, the government's looked at the issue of farmland. We should widen that review. Thirdly, we should look to restrict investment overseas by the government-mandated super funds. The New Zealand Super Fund, for example, has been told to increase its investments in New Zealand to 40% of the fund from currently around about 20%. And the KiwiSaver funds currently are putting around 50 to 60% in New Zealand, the rest overseas. Maybe they need to lift that up a bit. And finally, I think New Zealand should look to tilt its economy away from consumption and from the government sector into the exporting and production sector, particularly of high-value jobs in IT, in various areas where there's high productivity, not the sort of low productivity commodity type production that we've been quite good at, or the low value jobs we're seeing in tourism, but into higher value information, communications, technology, niche manufacturing, those sorts of areas, high value. And there's no better example than that, for example, for Xero or some of the technology companies like Fisher & Paykel Appliances. There we have it, 5 ways in which New Zealand can insure itself, if you like, against the currency wars, to defend ourselves against the turmoil on financial markets and be ready for what is an extremely volatile time. I'm Bernard Hickey. That was a special economic weather report. My views, of course, alone, brought to you in association with Bank of New Zealand.